Hey guys, what's up? Today I decided to do something a little bit different and instead kind of just cover a topic that is very essential to stock trading, and that is the support and resistance lines, areas of um, the securities that we buy and sell. So, what is the support and resistance? So, the support is just an area where a stock in a downtrend is predicted to pause as investors decide the new direction. So, they are very key deciding points in the direction of a stock because one of two things can happen: a bounce where it has established this area of support, this line, and it'll curve back upwards. So as it's coming down, um, as it's coming down in price, it'll curve and then bouncing off this line and curve back upwards to go back to an uptrend and start gaining um, gaining price, I guess, becoming more expensive. Or for support, it can break it and it can violate that support line. It can just ignore complete. Well, not ignore it, but it can basically just break right through it as if it wasn't even there. And that is extremely important because it shows that maybe the stock is now seen as less valuable than before. And now a previous price point, which would have been very ideal to many investors, now is not so much. And now the price has moved on to a lower status quo, if you want to say, of a range of prices. So usually, if the support holds, because the supports are lower in price, there's generally more demand. That is the law of demand. Um, Lower price, more demand. So that usually will cause the security to increase in price. But as I said before, there could be new news that may have made the company um, have a negative public image, or maybe, for example, of the biotech companies, maybe some of their medicine or something like that it was not approved. That could make it the stock tank, and the support will just be completely ignored as the stock is seen by most investors as not that valuable. That status quo price, that baseline price where most investors would go and get in because it's a steal, is now not a steal anymore. So resistance is just basically like the opposite of the support. It's the top ceiling of where many investors think that the security will go. So it is the it is the area where if the stock is in an uptrend, it is expected to pause as investors decide which direction it will go in. And like support, there's also a very key deciding area with two outcomes. It can go through the pullback. It can go through a pullback. So it's kind of like the opposite of what I described before. It's uptrending, uptrending, and then curves, and it comes down in price, and then it starts the price gets smaller and smaller. Um, or it could break through, and that's just like it's exactly the same, except maybe it's positive news this time. Maybe there's new products, like for example, when the iPhone came out, that's a new product. So no matter what the resistance was before, that new product shot the price up through the resistance as the company was now way more valuable because they had this amazing product. And so the company was more valuable and more investors saw more value in that stock. But usually, if nothing much has changed, pullbacks occur due to the increased price, which decreases the demand. Law of demand. If they see it as overextended, and so they want to sell and take their profits there, and because there's so many people trying to sell there, then that makes the price go down, and it just feeds this endless cycle of ups and downs, support and resistance. So this is a picture of what a horizontal pattern of support and resistance look like on a real chart. So this is the TD Ameritrade chart, and you can see the green and the red, they're called candlesticks, and so you can see. Oh, yeah. I don't think you can see my mouse. So yeah, but you can see that the bottom red line is is acting as the support, and the top horizontal red line is acting as the resistance. And so you can see it bouncing from bottom to top, bottom to top. And of course, it's not always like 100% accurate. As I said before, it's more of an area where it's predicted to reverse or uh, bounce or pull back. But yeah, this is a very nice pattern. It's very easily it's very predictable. You can see at the very beginning it jumps up to the resistance level, then it comes back down, then it jumps up, then it comes back down, then it jumps up. So that's a very nice pattern and very predictable. So yeah, when talking about support and resistance, you usually um, come about and talk about three different types of patterns. So the first pattern that we're going to be talking about is the horizontal pattern. And so this is exactly what you just saw before with the wheel chart. And it is where the resistance and the support are just straight horizontal lines, and the stock just fluctuates between them from support to resistance. And I personally like to trade these because it is very predictable. You know where the stock is going to curve up, and you know where is a good place to sell. The pattern is in your favor, I guess you could say. The it is, yeah, I think something yeah a very key important factor for the stock market is predictability. You want to be able to know where that stock is going before it goes, so that you can make the money. And with a horizontal pattern, it's very easy to see. Support and resistance is very defined. Of course, it's not always going to be this picture perfect, but that's the general idea of support and resistance. And you can see that the stock going up and down. You just buy the support, sell the resistance. Simple as that. And then we have the next pattern that I usually like to trade, the ascending pattern. A little bit less risky than the horizontal pattern because it has a nice ascending pattern, so the pattern is definitely in your favor. And this is where the resistance and the support are pointing upward, and it's making higher highs. So the high of the stock continually gets higher and making higher lows. The low of the stock is getting higher as well. This because the support and the resistance have a positive slope, and it's going upward. And this is also a very nice pattern to trade because um, you can easily identify the support and resistance. And even if you're off by a little bit, maybe you bought a little when the stock had already bounced off the support or something, or maybe it was a bit too close to resistance. That's okay because the ascending pattern makes it so that you're trading with the pattern, and that is a very important thing in the stock market. Never try to trade against the pattern because more times than not you're going to lose. So yeah, of course, another really great example of resistance and support. And then now we have the descending pattern. And this one is a little bit more risky, and I personally don't really like to trade it. So in this pattern, the stock is making lower highs and lower lows. And if you're going to be trading this one, you're going to be trading against the pattern. And you have to you have to be very careful when you are looking at this stock, because even if you do buy at the support, I mean, you're not guaranteed to make money because the resistance is going down as well, the support is going down. So yeah, this pattern, um, maybe you can try to scalp it, which is try to just get the little tiny bits, little swings of this descending pattern. But for like a beginner or someone who's just getting into the stock market, definitely not. This is definitely not a pattern that I would recommend. And there's lots of different patterns in the stock market as well. There's many names for it. Like for example, this is called a double bottom, and that is because it hits the support line twice. It hits it once, and then it hits it twice. It makes a kind of W shape and then after that second bounce off the support, it breaks past the resistance. And you can also have a double top, which is just the opposite, like an M shape, where it'll um, touch the resistance twice and then break down. So it'd be, uh, getting, I guess, cheaper. It'd be losing its value. And a double bottom, it's gaining value. And you also have something like this, like a pendant, I believe it's called, where the resistance and support are closing in on each other, and um, these are a little bit risky because you don't know which direction um, it could go. I mean, the resistance and support, they help determine um, where to buy and sell when it is in this like kind of flag shape, but it could easily go up or it could go down after it's broken past this flag. There's a lot of other patterns as well, such as the ascending triangle, the descending triangle, the falling wedge, the head and shoulders top, but they all rely on this fundamental principle of the resistance and the support. Okay, and a golden rule and this is the last thing I want to leave y'all with, is the rule of old resistances become new supports. And you can see it clearly here. And it goes back to that idea of the inherent value of that stock. So say for example this is stock XYZ, right? And so it was trading between the old support and the old resistance. And suddenly some huge piece of information came out, like maybe XYZ signed a big deal that would give it millions and billions of dollars of funding. Now the stock is more valuable, and so it breaks that old resistance, and now begins to trade between this new support, which was the old resistance, and this new, the new support, which is the old resistance, and this new resistance. And it just goes back to, and it just shows that the inherent value of the stock to investors has increased. So a new demand, so a new support and new resistance must be made. And so that was just my little lesson on support and resistance. I really hope you guys liked it, and feel free to share the video. This is Edward. Bye.